Good morning and thank you for joining us today. We are pleased to present our financial results for the year ended 28 February 2025. This presentation will be available on our website later today. We will begin our presentation with the operational overview. Yolanda will then present the financials. I will discuss our ESG performance, followed by fleet investment and performance, after which I will then discuss industry-related matters and close with our strategic objectives. There will be an opportunity for questions at the end of the presentation. Operational overview. Due to circumstances beyond the group's control, SS Mozambique remains held for sale since August 2020. Consequently, the results for the year and comparative year have been prepared to reflect continuing and discontinued operations. I shall now cover the key indicators for continuing operations. Contract revenue increased by 8% to 7.7 billion. Operating profit increased by 59% to 333 million at an operating margin of 4.4%. The group's current order book has increased to 8.6 billion. Cash on hand decreased from 755 million to 470 million, mainly due to capital expenditure and capital repayments. I will now cover the financial performance of the group's 4 regions. Inland region delivered another strong performance with an increase in contract revenue to 3.3 billion and an operating profit of 187 million. Coastal region showed a significant improvement with an increase in both contract revenue and operating profit to 2 billion and 65 million respectively. Western Cape region posted another solid performance with contract revenue decreasing to 882 million and with a substantial increase in operating profit to 73 million. Africa region's contract revenue is 1.5 billion, with a healthy increase in operating profit to 92 million, which includes a 30 million operating loss relating to the Highback JV and a net recognition of the Kalaba settlement of 39 million. With respect to the Kalaba settlement, the Zambian Court of Appeal ruled in favor of Stefanutti Stocks and its joint venture partner. Following the ruling, the parties have agreed to a settlement amount, however, repayment terms still need to be concluded. With the exception of the Botswana operation, all remaining operations are performing to expectation. Order book at April 2025 and opportunities. Inland's order book is 3.5 billion with short-term potential awards of 4.2 billion and future opportunities of 34 billion. Coastal has an order book of 1.4 billion with potential awards of 5.6 billion and future opportunities of 16 billion. Western Cape's order book is 2.6 billion with short-term potential awards of 1.8 billion and future opportunities of 43 billion. Africa has an order book of 1.1 billion with short-term potential awards of 3.6 billion and future opportunities of 26 billion. The group's current order book is 8.6 billion with short-term potential awards of 15.2 billion and future opportunities of 119 billion in the following sectors: renewable energy, electrical infrastructure, mining, transport and rail infrastructure, marine, oil and gas, water and wastewater, data centers, industrial, commercial and retail buildings. Kusile Power Projects update, SSBR joint venture, package 16. All contractor claims giving rise to entitlement for extension of time plus costs, which occurred before 31st December 2019, are considered to be Claim 5. The parties and their respective experts have filed all submissions, notes and opinions with the Dispute Adjudication Board, DAB. The DAB is expected to issue a binding decision by mid-2025. Either party may issue a notice of dissatisfaction with the decision and refer the dispute to arbitration. However, such a decision will remain enforceable unless and until overturned in arbitration. All contractor claims giving rise to entitlement for extension of time plus costs, which occurred after December 2019, are considered to be Claim 6. The contractor has filed numerous claims over this period, but these have not been resolved. A consolidation of these claims was filed in May 2025 and will follow the contractual process. Should Claim 6 fail in the contractual process, it will be referred to the DAB for resolution. Eskom has notified the contractor of its intention to deliver delayed damages claim for late completion by the contractor. We expect to receive this claim in June 2025. The contractor will defend this claim through the contractual process. Should a mutually acceptable outcome not be achieved in the contractual process, then the dispute will be referred to the DAB for resolution. Due to the quantum of Claim 5 not being finalized and the processes relating to Claim 6 and the delayed damages claim being uncertain, no claims have been recognized in the financial statements. SS Izazi, Package 28. The parties resolved the measurement of the works and between themselves agreed the values of all compensation events. The parties have now signed a settlement agreement confirming that the adjudicator will not be required to publish his decision and that there are no further payments due to either party. Thus confirming that our final payment application was accurate and that no overpayments were made as alleged by the project manager. I would now like to hand over to Yolanda to present the financials.
Thank you, Russell. The group reports an 8% increase in turnover to 7.7 billion. Operating profits significantly increased to 333 million, representing an improved operating margin of 4.4%. In line with the restructuring plan, the disposal of SS Construções Mozambique Limitada and Stefanutti Construction Limited remains as held for sale. Going concern. The directors consider it appropriate that the group's results for the year be prepared on the going concern basis, taking the following into consideration. The current order book, short-term potential awards, identified prospects over the medium and long term, continuing operations executing the group's order book profitably, reaching a favorable outcome on contractual claims on the Kusile Power project, continued support from the lenders, and successfully implementing the remaining aspects of the restructuring plan. The loan provided by the lenders has assisted with the group's liquidity, even though at 28 February 2025, the group's current liabilities exceed its current assets by 1.3 billion, and as of that date had an accumulated loss of 1.1 billion. The matters as noted above, including uncertainties surrounding the contingent liabilities, as stated in Note 26 of the group's consolidated annual financial statements for the year ended 29 February 2024, continue to indicate that a material uncertainty exists that may cause significant doubt on the group's ability to continue as a going concern, and as a consequence could impact on the group's ability to realize its assets and discharge its liabilities in the ordinary course of business. For the first time since 2021, the group reports a positive net asset value of 16 million. The group executed contracts to the value of 39 billion since 2020, and the lenders continue to provide guarantee support for current and future projects. Restructuring plan update. The group reached agreement with the lenders to extend the capital repayment profile of the loan as well as its duration to 30 June 2026. Capital repayments of 148 million were made during the financial year. Interest is settled monthly and amounted to 115 million. Restructuring costs incurred of 28 million. The outstanding balance of the loan at year-end is 849 million. The following aspects of the restructuring plan remain outstanding. Concluding the disposal of SS Mozambique. Reaching a favorable outcome from the processes relating to the contractual claims on the Kusile Power project. Concluding the repayment terms with respect to the settlement reached relating to the Kalabo-Sikongo-Angola border gate road in the western province of Zambia, the Kalabo settlement, and an evaluation of the company's capital structure, including the potential of raising new equity. The group will continue to update shareholders on the progress of the various aspects of the restructuring plan. With respect to continuing operations, contract revenue increased to 7.7 billion, of which the inland region contributed 3.3 billion of the group's revenue. EBITDA increased from 270 million to 428 million, primarily due to an improvement in operating performance and a net recognition of the Kalabo settlement of 39 million. In terms of the Kalabo settlement, the Zambian Court of Appeal ruled in favor of the group and its joint venture. Following the ruling, the parties have agreed to a settlement amount. However, repayment terms still need to be concluded. The group recognized 148 million, being its 50% share of the settlement amount less costs. An expected credit loss of 109 million has been recognized due to the uncertainty surrounding the recoverability thereof. This will be assessed on an ongoing basis. In addition, a 12 million tax charge has also been recognized. Continuing operations reported a significant increase in operating profits to 333 million. Depreciation increased to 91 million due to the acquisition of plant during the current and prior year. Improved cash balances over the year resulted in an increase in investment income to 50 million. Interest on the loan reduced to 115 million from 134 million due to capital repayments made. The financing of capital expenditure of 314 million during the year contributed to the increase in interest relating to installment sales and lease liabilities to 25 million, compared to 7 million for February 2024. The settlement reached with the Foreign Tax Authority resulted in the reversal of interest previously accrued for of 21 million, contributing to the reduction in finance costs. The tax charge is impacted by the recognition of a deferred tax asset on a portion of the assessed loss for the South African trading entity. Furthermore, the settlement reached with the Foreign Tax Authority, as previously mentioned, reduced the tax charge with 22 million. Profit after tax for the year increased significantly to 209 million, compared to the 26 million for the prior year. With respect to discontinued operations, the political unrest following the Mozambican elections in December 2024, together with ongoing security concerns and political instability in the north of the country, negatively impacted the construction sector. This resulted in project delays and operational disruptions, impacting the Mozambique operations, resulting in a loss of 78 million, consisting of a fair value adjustment of 51 million, a trading loss of 22 million, and a forex loss of 5 million. The profit for the year for total operations improved to 131 million. The statement of financial position. Property, plant and equipment increased from 529 million to 865 million due to capital expenditure of 452 million incurred during the year. The group acquired plant and equipment of 149 million through cash transactions. In addition, 238 million was financed through installment sales, whilst another 64 million related to right of use assets. Contracts in progress increased from 536 million to 595 million, predominantly due to a specific project linked to milestone invoicing within the renewable energy sector. Included in contracts in progress is materials on site to the value of 223 million. Contracts in progress days increased slightly to 33 days. Trade receivables increased in line with trading activity, whilst other receivables reduced due to the finalization of certain joint ventures in the Africa region. Debtors days remained similar at 64 days. Non-current assets held for sale and disposal groups comprises assets relating to the Mozambique operation of 728 million and assets held for sale of 28 million. Liabilities associated with this disposal group amounts to 536 million and includes a bank overdraft of 59 million. As mentioned earlier, a fair value adjustment of 51 million was recognized. With respect to the sale of the Mozambique operation, the purchaser is renegotiating various aspects of the agreement, including the purchase price and payment terms. On the liability side of the statement of financial position, interest-bearing liabilities increased slightly from 1.2 billion to 1.3 billion due to capital expenditure financed through installment sales of 250 million and lease liabilities of 64 million. The increase in financing activity was offset by capital repayments of 294 million, of which 148 million was made towards reducing the loan to 849 million. The group envisages to make further capital repayments towards the loan, utilizing proceeds from the disposal of the Mozambique operation and a favorable outcome from the processes relating to the contractual claims on the Kusile Power project. Trade payables decreased slightly despite increased trading activities, whilst other payables reduced due to the finalization of certain joint ventures. Excess billings over work done decreased slightly by 68 million to 1.2 billion, which includes material on site of 131 million. Provisions decreased marginally from 966 million to 929 million, despite the increase in trading activity. Analyzing the statement of cash flows. The cash flow statement is presented for total operations. The improved performance of the group resulted in cash generated from operations increasing to 403 million, including working capital of 60 million compared to the 322 million of the prior year. Total tax mainly comprises of 26 million of foreign taxes relating to Eswatini and Zambia, 69 million of withholding taxes, of which 57 million relates to the Zimbabwe branch, offset by an 11 million tax refund for the Botswana entity. Included with investing activities is capital expenditure of 149 million. Other investing activities mainly comprises proceeds of 16 million received from the disposal of property, plant and equipment. Financing activities mainly reflect the reduction in debt of 294 million as previously mentioned. Cash generated from operations of 403 million was utilized for capital expenditure of 149 million and the repayment of debt of 294 million, thereby reducing the bank balance to 470 million. Guidance for continuing operations for the next 12 months. Inland region, we expect an increase in contract revenue with a slight reduction in the operating profit margin. Coastal region, we expect a slight reduction in contract revenue with a similar operating profit. Western Cape region, we expect a significant increase in contract revenue with a reduction in operating profit. However, based on the order book, more revenue will be generated during the second 6 months of the year. Africa region, we expect a decrease in contract revenue with a reduction in operating profit on a normalized basis. However, based on the order book, more profit will be generated during the second 6 months of the year. For corporate services, we expect similar costs as currently reported. I will now hand back to Russell.
Thank you, Yolanda. Our ESG strategy is designed to manage risks associated with ESG through the use of effective practices and policies. The group has its own in-house digital platform to manage these risks. Our people are our biggest investment, our true enablers, and are instrumental in our success. The group currently employs over 6,000 people, of which just over 2,000 are permanent, and the remainder being limited duration contractors. During the year, 12.4 million was invested in skills development training, bursaries, and scholarships. The health and safety of our people remains central to our operations, with preventative measures, training, and accountability structures in place to protect every employee every day. A systematic approach is applied in identifying, assessing, and mitigating health and safety risks, supporting a safe working environment. Health and safety performance is rigorously tracked through audits, trend analysis, and incident reporting to drive continual improvement and reduce workplace incidents. There were 0 fatalities during the year. The group's lost time injury frequency rate is 0.08 and a recordable case rate of 0.29. Our environmental management system reflects our ongoing commitment to minimizing our environmental impact and promoting sustainable practices across all operations. This system enables us to identify, assess, and manage environmental risks and impacts systematically, ensuring responsible operations and long-term environmental stewardship. During the year, there were no reportable environmental incidents or legal contraventions. The group continues to be a level 1 broad-based Black economic empowerment contributor measured against the construction sector charter, with the following scores: Black ownership of 64%, management control 63%, employment equity 77%, skills development 124%, preferential procurement 115%, enterprise development 100%, and socio-economic development 120%. The group is enhancing its use of cutting-edge technologies in project execution, including BIM 4D, 5D, 6D, drones for monitoring site progress, and the telemetry sensors for assessing fuel usage, equipment health, and overall productivity. We have adopted a data-driven approach to analyze company information, improving project performance, and enhancing agile decision-making. We are initiating a training strategy to provide our teams with essential digital skills. The group holds the following ISO certifications for environmental management, quality management, health and safety, and information security. Plant is another significant enabler in our group, and we pride ourselves on the quality of the plant. The group was not able to make significant investment into its fleet since 2018. Due to this lack of investment, the current fleet aging is too high. The group adopts a plant replacement policy aimed at ensuring an optimal size and age of its fleet. In 2024, the group invested 107 million. During this year, 302 million was invested through the utilization of credit facilities and a further 100 million acquired with cash. As part of our plant strategy, we track cost of fleet versus percentage of revenue. In 2024, the plant cost to revenue was 62%, with plant availability of 85%. Due to the investment over the last 2 financial years, plant cost to revenue decreased to 44%, with an increase in availability to 94%. Our internal target is to not exceed 40% of cost to revenue and have availability of over 91%. Further investment will be required to manage the cost to revenue at an acceptable level and reduce fleet aging. I will now cover industry-related matters. The group has experienced less disruption of unlawful activities by certain communities and informal business forums in several areas of South Africa. There continues to be a lack of public sector infrastructure spend in South Africa. Should this improve, it will benefit the group. The Employment Equity Amendment Act was enacted on 1st January 2025, excluding the ministerial sector targets and accompanying regulations. Following consultations with various economic sectors in February 2025, the Department of Employment and Labour published final sector targets and regulations on 15 April 2025, rather than issuing draft versions for further public comment. This approach has raised concern among industry stakeholders, including our industry association SAFSEC, as it is without meaningful consultation or supported by scientific data. Several stakeholders have initiated legal proceedings challenging these targets. The group will endeavour to comply with the Act. In conclusion, our focus remains on successfully completing all outstanding items in our restructuring plan, achieving favourable outcomes from claims on the Kusile Power project, and continuing our focus on improving operational performance. This brings us to the end of our presentation. Yolanda and I are now available for any questions. Thank you.